Our next example from Chapter 16 is the construction of a cash budget for April, May, and June. And if you remember making cash budgets in Principles of Accounting 2, this will be a good refresher of that information. So we're going to make a cash budget. We have information that we believe 5% of our credit sales will never be collected. 35% are collected in the month of the sale, and 60% are in the following month. So that's our cash collections. Then we need to know about our cash outflows. So we know that our purchases are paid in the month following the purchase. And then we have information about March's credit sales, and we use this information to complete the cash budget. So we need to know what our beginning cash is. So we have beginning cash in April is given. It was 182,000. And then our cash receipts are cash collections from credit sales. So we're doing those cash collections from credit sales. Remember that we need 60% from the previous month's sales, or 35% of this month's sales and 60% of the previous month's sales. So we're going to add together. We have credit sales in April of 689,000. And we're going to take that times this 35%, and we're going to lock that. Plus 60% of our previous month's sales. So our previous credit sales were in March of 561,000. So that is our cash collections from sales. So our total cash available is the two of those added together. Then we have our cash disbursements. So our purchases, our cash disbursements or purchases are the previous month's credit purchases. So we need March's, here the 289,000. Then we have wages, tax, and interest, and those come from our table, and equipment, and we can copy those across, pulling down from the table. So our total cash out is those added together. We can copy that formula across. We can copy our total cash available formula across. And our ending cash balance is total cash available minus our total cash disbursements. That formula can also be copied across. Now, our ending cash balance from April becomes our beginning cash balance from May. And now we just need our cash collections from May. We can't copy April's formula because April had the March, so it's not a clean formula copy, but we can copy May's formula to June. So let's do that. So we have May's credit sales times 35%. We'll lock that cell. Plus 40% or 60%. Unlock that cell. Times, we want the previous month's credit sales. So April's credit sales. So our cash collections in May, and we can copy that over to June. And now we have our complete cash budget for the second quarter of the year. in this example, we're looking at the cost of maintaining a line of credit with a bank. So this is a line of credit that allows us to borrow up to $40 million at any time. Our interest rate is 0.527% each month. In addition, 4% of the amount we borrow must be deposited in a non-interest bearing account. So that is a committed line of credit where we have to maintain a minimum balance as part of the agreement. So we want to know, one, what is our effective annual interest rate? Because we're given a monthly interest rate. We want to know what the effective annual interest rate is. And then we want to know how much interest we'll pay from a $15 million loan. So first, our compensating balance amount. So how much do we have to keep in that account with the compensating balance? This 4% of what we borrow must be deposited in a non-interest bearing account. So taking into account our current interest rate, because anything we borrow, we can't spend all of what we borrow, is what that's saying. We have to put a portion of it in a non-interest bearing account, and we have to pay money on that. So we have 1 plus the interest rate, our interest rate to the power of 12 for 12 months minus 1. It's a monthly interest rate, so we're taking it times 12. Okay? So our compensating balance amount has an effective interest rate of 6.51%. So now we can use that to figure out what the effective annual rate is of the total borrowing. So we have our compensating balance amount divided by 1 minus the compensating balance amount. So our effective annual rate is 6.96%. If we're going to borrow $15 million, so remember that we have to put a portion of it in a non-interest bearing account. So if we want to spend fully 15 million, then we need to borrow more than 15 million so that a portion of it is in that account. So how much do we need to borrow if we want $15 million? Well, 15 million divided by 1 minus our compensating balance percent. So we need to borrow 15,600 or 15,625,000. So we'll have our 15 million in cash. We have to put the 625,000 in that compensating balance account. The total interest we'll pay is the amount that we borrow times 1 plus our interest rate to the power of 6, because it's 6 months, minus the amount that we're borrowing. There we go. Okay. Maybe if I just retype it, equals the amount that we borrow, parentheses, that's what I was missing, times 1 plus the interest rate to the power of 6 minus the amount that we borrow. There we go. So the total interest paid on this $15.6 million loan is $500,617.69. On our last example, we're going to calculate what the company's average balance in accounts payable and accounts receivable are given on the reported cost of goods sold and their credit sales. So we have information about their cash cycle, their operating cycle, and their inventory period. We need to know what the payables period is. So we have a cash cycle, operating cycle, and inventory period. Well, we know that the cash cycle is the operating cycle minus the payables period. So if we rearrange that formula, take operating cycle minus cash cycle, that will give us the payables period. So operating cycle minus cash cycle. Our payables turnover then is 365 divided by the payables period. So our payables turnover is 15.27. So our average payables, if we rearrange that formula, so we know that the cost of goods sold divided by the average payables equals average or payable turnover. So if we take the cost of goods sold divided by our average or payables turnover, that will give us our average payables. So these are the same exact formulas that we've been using for financial statement analysis ratio. They're just being rearranged. So now we have our receivables period, and we're going to do the same thing. We know that the operating cycle is the receivables period plus the inventory period. So we can rearrange that equation, take the operating cycle minus the inventory period, and we are given our receivables period. We divide that by 365 by our payables period, we get our receivables turnover. The receivables turnover is credit sales divided by average accounts receivable. So if we flip that and take the credit sales divided by the receivables turnover, we get the average accounts receivable. So we know at the average amount that they had per month in accounts receivable was $75,375, and the average amount they had each month in their payables account was $29,138. Those are the Chapter 16 examples.